Hello and welcome to this special programming. I have a very special guest with me, Neelkanth Mishra of Credit Suisse. Needs no introduction in the world of capital markets in India. Neelkanth, thanks so much for taking out time for us. First, let's start with what's happened in the last few weeks or so, or the last few months or so. You track the FII shareholding data pretty closely. What's happening with the FII side of the market? Markets are not falling much. FIIs are selling. Is it only because of the primary market issuances?
Yeah, hi Pankaj. Thank you for having me on the show. The the FII behavior, I think, is more because of what's happening globally. I think there is elevated uncertainty in global financial markets. The Fed is trying to tighten aggressively as they are starting to realize that they are perhaps behind the curve. This is happening, unfortunately, at a time when global demand indicators are starting to weaken. So we've been tracking our proxy for global retail sales. They were significantly above trend for almost all of 2021. And then there was a very steep fall. It was protected by, I think, pre-buying in October, November, but in the December sales in the US, the numbers were really weak. And when you put this together with consumption weakness in China, the expected weakness in real estate construction, etc., I think the global end demand situation is looking a lot weaker than what the supply constraints would suggest. At this time, it is going to be very difficult for policymakers to stimulate the economy. And this is a very new situation for global markets, because over the past decade, we are used to a situation where whenever demand weakens and stock markets take a tumble, that the monetary and fiscal taps get opened. This time, the primary focus, especially in the US, seems to be inflation. And therefore, as growth weakens, we may not see that stimulus coming through. And I think as that readjustment of expectations happens, the global markets are likely to stay quite volatile. Emerging markets in particular, I think, have seen outflows. And that's the usual trading pattern, that if the US is tightening, you pull money out of emerging markets. And I think the FII selling that we have seen is a reflection of that. For India per se, I think the cyclical rebound is actually doing very well, and we expect it will continue to pick up in the next couple of quarters.
Right. My second question was based on this only, the point that you made. Everybody, whenever they think that Fed is going to taper, Fed is going to raise rates, they believe we are back to 2013, where demand just collapsed across asset classes. Do you think this time around, India, overall global world, global growth, much better prepared?
I think the emerging markets are definitely, their current account deficits are not really as high as they were in 2013, not just for India, but for several other emerging markets as well. And many of them have actually prepared themselves with much larger reserve positions. So I don't think they are that in that weak a position. But at the same time, remember that even though inflation may be primarily a US phenomenon right now, because in Japan, in China, and large parts of Asia, inflation is not that big a policy headache right now. The reality is that most asset classes globally are benchmarked off the US 10-year Treasury yield. And that's why I think the volatility in global markets can be quite broad-based. This will be perhaps at a time when the equity and bond markets both start to see weak demand. So this is a readjustment process. I don't think the world has ever seen, for example, we have never seen, US inflation being 1.5, 2% points higher than India's inflation for several months in a row. This takes some getting used to. And I think that uncertainty is going to be causing a lot of volatility across markets.
Right. Let's just talk about the upcoming event, which of course is the budget. Last time around, it was a great event. Markets have rallied overall, and you as a strategist can also say that it coupled with what happened with the global rally. What to expect going into the budget?
I think the challenge for policymakers in India, state and central level, is shifting again. So for most of the prior decade, it was about fiscal consolidation. I mean, how do we get the fiscal deficits back in line? What is happening right now is that the markets are primed for higher deficits. So they are expecting that the center and the states will have high deficits, and tax collections are going up, but the governments are being unable to spend. So I think the biggest variable to track right now is the cash balance that governments have with the RBI, which is actually more than 2% of GDP right now. And this is coming primarily as the government functioning was very badly impaired by the lockdowns and activity restrictions. So as we get into the budget, I think and not just the central budget, but the state budgets that will also get presented over February and March, I think the key variable to look out for would be what they are deciding to spend on. How much can they scale up spending? Because the tax revenues are good. I think the temptation would be to consolidate aggressively, but at the same time, the best way to get debt to GDP down is to grow the denominator, basically grow nominal GDP faster. And especially when the markets are primed for higher deficits, I think it makes sense to spend a lot more. So that would be the first focus area. At the same time, one of the key takeaways from the last year's budget was that it was very progressive. It showed clean accounts. It showed a path where the government was very focused on growth, very reform focused, privatization of PSU banks and several other such steps. Even if there are no concrete steps that affect the fiscal numbers, if the budget speech comes up with some such announcements, say on the personal taxes or personal income taxes, or some removal of exemptions, I think that will also be taken very positively. I don't know if that will be enough to offset some of the global markets turbulence that we are seeing. But yes, I think it will help India hold up better.
Right. Just in terms of expenditure, last year, of course, was a great higher spend on expenditure. This year, they may have some saving from the vaccination, the COVID programs that they have given. But do you think expenditure on such a high base cannot grow very strong, and that's why the quality of expenditure will be the key?
Totally. Absolutely right. And so the government, as I said, if you're going from 6.8 to a situation where you can theoretically consolidate to 5.8 or even a 5.5%, and this would be faster than what you had guided to, which is 4.5%. And here we're talking only about the central government by FY26. The fact is that if you consolidate too fast, you are actually going to shrink expenditure. And there is some natural expenditure shrinkage, which should be expected, and there shouldn't be that much of a vaccination requirement next year. I think the food grain supply should be lower. Fertilizer prices globally are starting to come off, so the fertilizer subsidy can come off as well. And it is possible that some of the disinvestment proceeds may improve next year as well. So you will have more space. And I think the expenditure or keeping it up and finding avenues where you can spend a lot more is going to be the biggest challenge for the center, and I must say for the states. The headline deficit in FY21, the revised numbers was 4.7% for states. In reality, if you look at how much they borrowed and how much cash they ended the year with, it will actually be lower than 3%, which is not very different from what was there pre-COVID. For FY22, the states are at 3.6%, but the borrowing is again below what was expected, and their cash balances have actually climbed further, and which suggests that they will end this year also with a deficit which is lower than 3%. So at a time when everyone expects it, so we have kind of, as an economy, incurred the costs of higher fiscal deficits by pushing up yields. The term premium in India is at a ridiculous level, but the benefits from that in terms of higher government spending have actually not come through. So just to give you a number, September 21 quarter, the GDP in real terms was about 0.3% higher than September 19 quarter, right? So the pre-COVID base quarter. But government spending was 17% lower. And this is the government final consumption expenditure. And this is at a time when governments the world over are actually boosting expenditure to support aggregate demand so that the economy doesn't contract. In India, the GDP is growing despite the government spending actually shrinking. And this is something that needs a lot of attention for the markets and as well as for policymakers, because the markets just look at the headline deficit and then say, oh my God, there is a problem. What they are not observing, perhaps, or not paying enough attention to, is the fact that there is like 4.5-5 trillion rupees of cash that the governments are sitting on, and how that gets spent is going to be very important. And you're right that it should be spent productively. The quality of expenditure needs to be good so that the multiplier is good, and that will, I think, be a good support for growth going forward.
Just in terms of fiscal deficit consolidation path, the no longer oil tailwind that they had earlier with the excise duty, how should one look at divestment programs and the oil revenues which will now not be there?
So oil revenues will be lower, and they're not going to be there. I think the total cut center and state put together on an annualized level, and this happened in November. So 4 months have already been seen in FY22. So we'll see 8 months of that reduction. Total was like 1.5 trillion rupees, which is large, but in the context of government taxation, I don't think that is a very large number. And this is coming at a time when, because of formalization and better compliance, I think the tax to GDP, even excluding the oil revenue, is actually not doing that badly. Corporate profits are doing well, so corporate tax growth will be strong, and therefore, I think the process of consolidation, in theory, can continue. Though, as I said earlier, the objective should shift from just managing the year-to-year fiscal deficit to looking at the debt to GDP and seeing how fast can we bring it down, right? Because 90% you are at a very tricky position. If your cost of borrowing goes up like it has, then very quickly you can get trapped into a trap where your interest costs start climbing and then your deficits start climbing, and that forces a reduction in the GDP, and that sort of brings down ratings, and a lot of other risks can emerge. So we need to get that 90% down to 70% over the next decade. And the best way to do that, in my view, is to actually grow the denominator. And that must happen with the center and the states coordinating on how to spend productively in a way that once the economy really takes off, it can be withdrawn, right? The simplest way to spend, and some states may be tempted to do that, is to give salary hikes to state employees, right? I mean, I'm not saying that should be done or that will be done, but that's one way of increasing expenditure, which will actually have some growth impact, but it will then create a permanent liability which you can't pull away from, which is what happened 10 years back. And I think that these are the most important issues as we go into the budgets for the center and the states.
Just a last word as far as we continue. In terms of inflation, say if the hyperinflation continues or the inflation goes ahead, what is the best way to play it as an investor?
So the one nuance that I would like to bring is that this is not global inflation. We need to, in our financial markets globally, we need to worry about it because the US, which effectively sets the cost of capital for most asset classes, is going through a bout of very heavy inflation. But this is not yet a global inflation problem, right? So if you see the debate in Europe as well, has been whether this spike in inflation to 5% is something that will persist. And I think that as we are seeing US inflation go up, we have to see what are the goods and services that the US can import, because then the differential starts to become a lot more attractive. And in conventional high inflation situations, what happens is that you start buying commodities. But here, I think you see Chinese inflation is actually less than 2%. The outlook on hard commodities like steel and iron ore is not that strong. The outlook on oil and gas, which is more geopolitical driven, what's happening in Russia and Ukraine and so on and so forth, or what's happening in West Asia. So I think this bout of heavy inflation in the US is perhaps best played through maybe Bangalore real estate, wherein a lot more of services get exported because the wage rates in the US are rising very rapidly, and there is not a visible pipe but an indirect pipe which you can visualize, where services, there is a greater propensity for engineers in Bangalore to provide more services, and therefore more hiring to happen. And it's not just Bangalore, Pune, Hyderabad, Chennai, and therefore hiring goes up, wages go up, and that boosts these markets. So that could be one way of playing this spike. In general, I think high PE stocks will perhaps come under some pressure because you can no longer keep projecting low interest rates forever, especially if the global cost of capital as anchored to US Treasury yields is starting to inch up. And my apologies, I didn't answer your question completely, the previous one on disinvestment. I think the disinvestment proceeds, even if there are 1 to 2 trillion rupees a year, they look small given that the center spends about 30 trillion, 32 trillion. Actually, last year's expenditure was 34 trillion rupees. But given how much of committed expenditure the central government has, this extra 1 to 2 trillion is actually very important for discretionary spending. And what would be ideal is if the government was to give a 3-year roadmap. And in fact, even for debt to GDP, I think that would be an ideal roadmap to have, so that you're not just obsessed with next year's GDP print, but you're looking at a path to bring debt to GDP down to a level which the markets will be comfortable with. I think disinvestment is very important. I think the 3-year roadmap of these are the assets that we would like to sell, and this is the amount that we expect to get is going to be ideal if it comes through in the budget.
Thank you so much, Neelkanth, for taking out time for us. Always good to get perspective view from you. Hope we can again speak after the budget is presented.
Sure. Thank you, Pankaj. Thank you for having me on the show.
In conversation with Rahul Shukla of HDFC Bank, he manages about a third of the entire loan book, focusing on MSME, commercial vehicle, rural side of the business. Rahul, always a pleasure chatting with you. Let's start by understanding your sense on how things are right now on ground. You're working absolutely on the grassroots level along with your team across the country. Give us a sense of feedback, how things are shaping up.
Thank you. I must tell you that last quarter, because we had some respite from the pandemic, me and my team, we were on travels every week between October and December. There was not a week that I was not out. And this was not to the metro cities in Bangalore or Chennai. And I always told people that go out to Shimoga. I went to Hubli and I went to Dharwad. And a variety of places. When you go to Chennai, my encouragement was that go out to Theni and go out to Namakkal, go out to Salem and Erode, and you will understand what is happening on the business space. When you meet customers, there is no dearth of orders. The economic activity is very strong. And in the last quarter, the overdraft utilizations by the MSMEs strengthened quite significantly to above 70% by the end of the quarter. Obviously, it did become a bit soft in the last 7 or 8 days of December, just before quarter end, because at that point of time, there was this scare on Omicron. People didn't have that conviction or belief. They didn't know what is going to happen. But now that it seems that this is a flash flood, as suggested even in a RBI bulletin on January 17th, there is much greater confidence, and we are again seeing very strong activity on the ground.
Rahul, we gather that HDFC Bank is doing phenomenally well, gaining market share, incremental market share as well on the MSME side. Give us some feedback, how much of that is happening, and what are you targeting now internally? What thresholds are you eyeing?
Thank you. Commercial and rural banking businesses, we did very well in the last quarter. It is an expectation that we should, continue to do well. And I've always maintained that this is a business that should continue to grow at 25 to 30% for, the foreseeable future as you look at it. So last quarter, our overall growth was approximately in this business 30% YOY, but the SME piece alone, that grew at 39%. In agri, we reversed the natural trend of negative growth in the quarter. And in transportation finance, we became the dominant player. Our market share in MHCV is about 30% of the industry today in terms of financing. But the question is today is not about number one. It is about credit expansion to those entities who are not yet in the formalized credit space. You would have seen research which suggests that the total credit requirement for MSMEs is about 50 lakh crore. Out of this, banks and NBFCs today provide just about 40%, in which we have a 13% market share. But the burning question is, how do we bring 5 crore entities, MSME entities who are not in the formal credit system into the formal credit system? And how does the formal credit system meet their 20 lakh crore credit needs? And that would be a very important question. So we are working on a plan for next year and over this decade. And I am very optimistic about this space.
How much of this growth which you are eyeing is sustainable? Is the size of the opportunity large enough? Also, this growth, what are the challenges on asset quality? Could it also cast a shadow on your asset quality because growth may be slightly on the riskier side? How are you balancing between the two?
Look, if you come back and step back and put pen to paper and you take a look that our destiny as a nation will be determined by MSMEs, and you plan forward, should we be 4 to 5 times, by the end of the decade in this space? Why not? There is so much unmet credit need. There are so many entities which are still not in the formal banking system. And by entity, our market share is pretty small. And so there is just a dramatic scope of expansion. So to that end, for next year, we are working on a 1+1 plan, which means that whatever is our book size by the end of March, we are going to match it rupee for rupee in terms of incremental disbursements in the next year, which is a huge amount of NTB acquisition. So that takes me to the second part of your question, which is asset quality. Now, we have continued to improve in our business, GNPA percentage in the business every quarter this financial year. But I must tell you that there is a lot of fear of this NPA, which, people voice, bankers voice, but in my belief is that it is unfounded. In fact, it is irrational and misguided if you do business the right way. And my working goals are very simple. When it comes to mid-corporates, for the banking system, the GNPA should be a few basis points, and the MSME GNPA should be less than 1%, which means that net NPA is a very, very small number. Which is why we as a business are a strong earnings contributor, in addition to being growth driver, but also a growth enabler for the bank, because we are contributing to priority sector lending disproportionately within the bank. So that is how I see this issue.
Right. All right, Rahul, thanks so much for chatting with ET Now today. Thank you very much for your time.